University Education, and today we're going to look at what is a stock. This is part of our Equity Basic program. As always, just a reminder that we're going to go through this without regard for your personal investment objectives or needs. We are not financial advisors, so just make sure that you practice trade and understand how to manage risk before moving into the markets. So, what is a stock? A stock is a type of investment that represents real ownership in the company. It's equity. You're buying an equity stake. Investors buy stock in companies that they feel will go up over time. And we want to buy into companies that we feel like are strong and have good business models and growth opportunities. If that happens and the company stock goes up, it will likely be because the company's good and strong and growing. And if the company's good and strong and growing, it's likely to have a company stock price that's reflecting that growth by going up in price. So they're related, right? If the company gets better and stronger over time, the stock is more likely to reflect that. The stock can be sold at any time for a profit if the price is increased. We, of course, could sell our stock as well if the price has gone down, but we would be taking a loss. Or a stock could be retained long term. You can take in dividends. You could even pass on that investment to kids and grandkids and so on. So, stocks are literal equity ownership stakes in companies. When you own a company, you're part owner of the profits of that company. So the CEO, the board of directors, they decide on dividend payouts to the shareholders. They decide what part of the company profits will be retained for future expenses and business expansion needs. And they'll also decide, well, do we want to pay out some of these profits to the investors in the form of a dividend? Growth stocks that are really in their growth phase will not typically pay dividends. Companies that have been around for a long time and are well established and are real strong value plays, they will typically pay dividends. When you pull up dividend information, there will be some pieces of info in terms of what you receive as an equity shareholder. Some important details here. Number one, it will tell you your forward annual dividend rate. So this particular stock pays $6 per share in dividends annually. That's a 2.2% yield. So if you put $100, let's make it simple, $100 in, you're going to get about $2.21 paid back to you per year in the form of dividends. That's what they're projecting to pay. That's what they're expecting to pay. And usually that dividend yield will go up over time. So companies want to raise their dividend. And if the company grows and expands, then they'll typically do that. They'll pay out more and more profits to the shareholders over time. So this is part of the benefit of being an owner is not only can your share price appreciate over time, but it also can cash flow and can pay you income. And a lot of investors will create these dividend income streams where they'll own stocks and they'll live off of the dividends. Now you'll have to acquire a lot of stocks over time, but certainly a worthwhile investment opportunity for great companies that are growing strongly. I hope you've enjoyed this video on what is a stock and learned a little bit more about it. We'll see you next time.